Welcome to Unit 3.6, where we dive into efficiency ratio analysis. This unit will help you understand how efficiently a business is utilizing its resources to generate income and manage debt. For our first learning outcome, we analyze, apply, and calculate various efficiency ratios such as stock turnover, debtor days, creditor days, and gearing ratio. Additionally, we will evaluate strategies to improve these ratios. Stock turnover ratio shows how well a firm's financial resources are being used, specifically for stock. It measures the number of times a firm sells its stocks within a given period, usually 12 months. To calculate stock turnover, divide the cost of goods sold by the average stock. For example, if a business has a COGS of $100,000 and an average stock level of $20,000, it turns over stock 5 times per year. Higher turnover indicates better revenue and profit potential. You can determine how long stock sits before selling by dividing the number of days in a year by the stock turnover ratio. For instance, with a turnover of 5 times per year, stock is sold every 73 days on average. Let's calculate stock turnover for JKL. With a COGS of $500 and average stock of $250, the turnover is 2 times per year. This means stock is sold every 182.5 days. Debtor days measure the average number of days it takes a firm to collect money from its debtors. This is calculated by dividing debtors by sales revenue and multiplying by 365. Faster payments improve cash flow and reduce the risk of bad debt. However, a low ratio might drive customers away if they are not offered enough credit. To calculate debtor days for JKL, divide debtors by sales revenue and multiply by 365. For example, with debtors of 150 and sales revenue of 1,000, it takes 55 days to collect payment. Good credit control is generally considered to be between 30 to 60 days. However, this can vary depending on the type of business, such as a supermarket versus a car dealership. Creditor days measure the average number of days a business takes to pay its creditors. This is calculated by dividing creditors by COGS and multiplying by 365. To calculate creditor days for JKL, divide creditors by COGS and multiply by 365. For example, with creditors of 300 and COGS of 500, it takes 219 days to pay suppliers. Gearing ratio assesses long-term liquidity by measuring how much capital employed is financed by long-term debt. For example, a firm with long-term liabilities of $5 million and capital employed of $15 million has a gearing ratio of 33%. To calculate gearing ratio, divide long-term liabilities by total capital employed and multiply by 100. For instance, with liabilities of 1,000 and capital employed of 5,000, the gearing ratio is 20%. A higher gearing ratio indicates greater dependence on borrowing. Firms with ratios above 50% are highly geared, meaning they pay more interest and are more vulnerable to interest rate increases. High gearing is acceptable for large firms with less concern about repayment, during periods of low interest rates, or for highly profitable firms that can cover debts with their profits. To improve stock turnover, hold lower levels of stock, divest or dispose of unsellable items, and reduce the range of products stocked. Improve debt collection by charging for late payments, offering early payment incentives, setting up automatic payments, and refusing further business until payment is received. To improve creditor days, aim for a period of 30 to 60 days and develop better relationships with suppliers to extend credit without negative consequences. Another learning outcome is compare insolvency versus bankruptcy. Insolvency occurs when a business cannot meet its debts, leading to financial distress. Bankruptcy is a legal process where a company declares its inability to pay back debts, often resulting from insolvency.